Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories behind those weighty corporate reports. Today we're diving into Flaherty and Crumrine Preferred and Income Fund Incorporated's latest certified shareholder report. And let me tell you, it's a deep dive into preferred securities and what makes them tick. You want to know about income, interest rates, and how a fund manages its money. Then stick around because this report lays it all out. And hey, before we get too far, if you love getting these straightforward financial breakdowns without the corporate jargon, make sure you hit that subscribe button. Also, we've got a fantastic community growing on Discord, linked in the description below, where we break down even more interesting financial news. Alright, let's get down to business. We're looking at their annual report ending the 30th of November, 2025. This fund focuses on preferred stocks and similar securities, which can be a bit more complex than your average stock. Think of them as a mix between a bond and a stock offering income, but also carrying specific risks. The report kicks off with some performance numbers. For the full fiscal year, the total return on their net asset value, that's basically the worth of all their investments, was 8.6%. That's solid, but what's really interesting is the return on the market price of their shares, which was even higher at 11.3%. This tells us that the fund was trading at a discount, but still delivered good results for shareholders. Now, let's break down how they got there for the year. The investment portfolio itself contributed 8.0% to the total return. That's the core of their business. Then the impact of using leverage, which is basically borrowing money to invest more, added another 1.9%. Leverage can boost returns when things go well, but it also amplifies losses when they don't. They're comparing their performance to the ICE BofA Preferred and Junior Subordinated Securities Index. For the year, that index returned 4.2%. So the fund definitely outperformed its benchmark, which is a good sign that their strategy is working. Looking at the fund statistics on page 9, their net asset value per S-Hair at the end of November 2025 was $12.65, while the market price was $11.85. This means the shares were trading at a discount of 6.32% to their underlying value. This is pretty common for closed-end funds and is something investors need to be aware of. The yield on market price was 6.55%, indicating a decent income stream for shareholders based on the current share price. When it comes to the quality of the investments, they've got a good chunk, 49.4%, in BBB rated securities. That's considered investment grade, meaning it's relatively safe. They also have 31.9% in BB rated securities, which are a step below investment grade and considered higher risk, but these often come with higher yields. A smaller portion, 2.0%, is rated below BB, indicating higher risk. Looking at their top holdings on page 17, you see a lot of big financial names like MetLife, Citigroup, and Morgan Stanley. This aligns with their strategy of focusing on the financial sector. The fact that these are large established companies suggests a focus on stability within the preferred income space. Now, for the really detailed part, the portfolio of investments, this is where we see exactly what they own. On page 9, we start seeing specific preferred stocks and hybrid securities. For example, they own $3.3 million of Bank of America corporations, 4.375% preferred stock. These are detailed entries showing coupon rates, maturity dates or reset dates, and their value. It's a long list showing a diversified portfolio within the preferred space. Then on page 18, they get into contingent capital securities, often called COCOs. These are particularly interesting and risky. They are debt securities that can absorb losses or convert into equity under certain conditions. Like if the issuer's capital falls too low, they have 20.6% of their assets in these, primarily in the banking sector, for instance. They hold $2.4 million of Banco Bilbao Vizcaya Argentaria SAS 6.125% contingent capital securities. These COCOs are a key part of their strategy for higher income, but they come with significant risks if the issuer runs into financial trouble. Moving to the statement of assets and liabilities on page 21, we see the overall financial picture. Total assets are over $254 million. What is particularly noteworthy here is the loan payable of $91.1 million. This is the leverage we talked about earlier. It's a substantial amount, showing they are actively using borrowed funds to boost returns. The statement of operations on page 22 shows their income and expenses for the year. They earned over $16.6 million in investment income, mostly from dividends and interest. Expenses, including a pretty significant interest expense of over $4.8 million due to their borrowings, totaled about $6.8 million. This leverage, while potentially boosting returns, clearly comes with a cost. The statements of changes in net assets on page 23 show how the fund's value changed. For the year ending the 30th of November 2025, there was a net increase in net assets of about $2.5 million after paying out around $9.9 million in distributions to shareholders. This means they paid out more in distributions than they grew in assets for the year, which can happen when the focus is on income generation. The financial highlights table on page 24 gives us a per share view over several years. For 2025, the total investment return based on net asset value was 8.63%. That is a solid return. If we look at the total investment return based on market price, it was even higher at 11.31%, again highlighting that the market price was below the net asset value. On page 27, the senior securities table confirms their use of leverage. The total debt outstanding was $91.1 million for 2025. The same as the previous year, the asset coverage per $1,000 of debt was $2,785, which means for every $1,000 in debt, they have $2,785 in assets to cover it. This is well above the 300% requirement under the 1940 Act, indicating they are in compliance with leverage regulations. The notes to the financial statements starting on page 28 are crucial for understanding the details. They explain their accounting policies, particularly how they value their investments, since many preferred and debt securities trade in less liquid markets than common stocks. Valuing them at fair value using observable inputs or even unobservable ones is key. They also detail their federal income tax status, noting they intend to qualify as a regulated investment company and distribute most of their taxable income, meaning they typically avoid paying income taxes themselves. The investment advisory fee is 0.625% on the first $100 million of assets and 0.50% on assets above that. This is a pretty standard fee for actively managed funds. They also pay fees for administration, transfer agent services, and custodian services. The fund has authorized 240 million shares of common stock, but as of the 30th of November 2025, only 12.8 million shares were outstanding. This indicates they are not actively issuing new shares through offerings right now. The details of their leverage are laid out on page 33. The agreement with BNP Paribas Securities Corp charges them the secured overnight financing rate plus 0.90%. As of the 30th of November 2025, the interest rate on the borrowed balance was 4.95%. This cost of leverage is a major factor affecting their overall returns. On page 41, we get into their proxy voting policies. This is important because it shows how the fund's managers, Flaherty and Crumrine Incorporated, decide to vote on behalf of shareholders on matters presented by the companies they invest in. Their main principle is to vote in the best interests of their clients. Free from conflicts of interest, they review matters case by case, especially non-routine ones like mergers or changes to incentive plans. The report also highlights the portfolio managers R. Eric Chadwick and Bradford S. Stone. Chadwick manages $2.85 billion in other registered investment companies and $914 million in other accounts. Stone manages similar amounts. This shows they are responsible for a significant amount of assets. They're very transparent about potential conflicts of interest. Because they manage multiple funds, they might have to allocate limited investment opportunities among them, or their time and attention might be spread thin. While they don't get paid based on performance, they do receive bonuses tied to the firm's overall advisory fees, which naturally incentivizes them to keep assets under management, potentially leading to favoring accounts that contribute more to those fees. It's good to see that the portfolio managers themselves have a vested interest. R. Eric Chadwick owns between $10,001 and $50,000 worth of fund shares, and Bradford S. Stone owns between $50,001 and $100,000. Investing their own money alongside their clients is a positive sign. Finally, the report details the risks. Market events risk, preferred and contingent capital securities risk, concentration risk in the financial sector, credit risk, interest rate risk, liquidity risk, foreign investment risk, reinvestment risk, selection risk, management risk, risk of market price, discount from net asset value, valuation risk, and cybersecurity risk. That's a lot of risk, and it's essential for investors to understand. The fact that they specifically call out contingent capital securities risk is important, as these are complex and volatile instruments. So, what is the story here? Flaherty and Crumrine Preferred and Income Fund is navigating a complex market by focusing on preferred and contingent capital securities, aiming to deliver high income. They successfully outperformed their benchmark this year, but leverage, while boosting returns, also adds cost and risk. The fund is trading at a discount to its net asset value, which can be an opportunity for investors, but also highlights the risks associated with closed-end funds. Their significant holdings in the financial sector and their use of COCOs mean investors need to be comfortable with sector-specific and higher-risk securities. The management team appears experienced and transparent about potential conflicts, and their own investment in the fund is reassuring. Overall, this fund seems to be executing its strategy effectively, but investors should be aware of the inherent risks, especially around interest rate sensitivity, credit quality, and the unique risks associated with contingent capital securities. Alright, that's our deep dive into Flaherty and Crumrine Preferred and Income Fund Incorporated's latest filing. What do you think about their strategy and the risks involved? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more. And don't forget to join our Discord community for more ongoing discussions and insights. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.